this market looks like 2021, and that is not a good thing. That is not a good thing from a long-term shareholder point of view. In this video, I want to share my thoughts on the current markets. What I see at the moment, I see a lot of optimism, a lot of hype, a lot of craziness in this market, and a lot of stocks doubling, tripling in a short amount of time. And we saw what happened in 2021. The same thing happened in 2021, and that ended up in tears with a lot of losses. So this video is also a message for you to take care, to be careful in the current market. In case this is your first video from this channel, welcome. My name is Christophe Nour. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year. So I'm quite happy with the results. And the way I had this performance was in investing in simple businesses that I knew really well. You buy them at a fair price, and then this business is growing with more revenue, more earnings, more free cash flow, more buybacks, and you grow 20% per year, 25% per year. Okay, and this method is based on Warren Buffett's principles of just investing in what you know for the long term. But now I see a lot of people on YouTube or even Twitter that they don't invest. The speculation is here, because the stock market has gone up so much in 2023, 2024. It seems like the philosophy has changed for new investors. For every cycle of investing, you have booms and busts, and you see new people entering the stock market, and they think we can make a lot of money, get rich very easily, and then they crash and burn, and they learn the lesson, and then they become more conservative. But every couple of years, you have newcomers in this market. And in 2021, we had new investors that had never invested before, and that just started trading in Robinhood in 2020, 2021, so first years of investing, and the markets were really hot in 2020, 2021. Basically, if you invested just after the COVID, just after the pandemic, you made a lot of money in stocks. Okay, so you are quite happy and you can take more risks. So you put more money into a more speculative bet, and you win again. So you make a lot of money. So you take more risks. And then 2022 came, interest rates went up, all these speculative stocks went down, and they lost 80% of their money. I see that for a lot of people. I saw this. I saw many examples of this scenario in 2021, 2022. And now seems like we have newcomers again, people in 2023 that enjoyed the fun. In 2024 markets were hot, and now in 2025 we have a similar environment. And I don't know why, but people that join the stock market think that it's easy to get 20% per year for the next 10 years. You will get 30% per year because of you invest in great stocks for the future, and they invest in unprofitable companies thinking that they will grow profitably in the next 20 years. They will be key leaders. The base rate for some newcomers in the market is 15%. People think it's easy to make 15% without any due diligence, which is not. I mean, you can look on the average, the performance of the S&P 500. It's not 15%. You are more around 10. Even in the last decade, you should be around 12% or something like this. It's quite hard to outperform the market. You need patience, rational thinking, invest in what you know, and be sure about your decisions. And even if you do this, you will make mistakes. So a lot of people are expecting to make 25% per year in the stock market, and a lot of people will be disappointed because only a few people can do this for 10 years, 20 years. I mean, I've been doing this for 8 years, that I consider this a short amount of time. When I will be doing this for 15 years, I will say, yes, okay, now I have a good track record. So far, this is very minimal. And I have a couple of stocks that I want to mention on this video. I'm sharing my screen normally if everything is working, and I have a couple of charts for you. By the way, if you're looking for a complete framework to analyze stocks and build a strong portfolio, I have a coaching program. More on that at the end of the video. And what I see on YouTube, Twitter, is that a lot of retail investors are following each other and investing in the same stock, and that creates this optimism, this hype. I mean, that's great, fine to me. Do whatever you want, be like herds. I mean, that's good. If you can share information and compare the points of view, that's great. You will get a lot of information. That's amazing. But what I'm very cautious of is the hype and optimism regarding some stocks. You may know that Palantir is one of the best performing stock of the market. This company was a darling in 2020 and then crashed in 2022, and then is finding some revival here because the company is, I think it's profitable now. They show strong growth. Nothing against Palantir. Now the company is profitable again. They have some cash. I mean, this is a wonderful business, wonderful vision, but the valuation is very high. So I have nothing against investing in Palantir. Don't attack me, please. Congrats to you if you made money on Palantir, but I'm just afraid that not a lot of people think of the valuation concern. Now the forward PE ratio is 200 for this company. So if you invest right now in Palantir with a PE ratio of 200, you think that the company will be able to grow 30%, 40% for the next 5 years. And if you look at the track record, have they done this in the past? No. The company was unprofitable in the past. And look at the net income. It's very recent. They only made money since 2023. And now you have extremely good growth. But it's very hard to keep up with the growth. There is a report from Credit Suisse written a few years ago talking about how long can a company sustain high growth rates in revenue, in earnings. And the only company that could sustain 15% earnings growth for a few years was Google. For the rest of companies, you have some reversion to the mean. So now the business is exploding for good measures, a lot of revenue, a lot of contracts, great stuff from the management of Palantir, and the business has maybe doubled its earnings or tripled its earnings. If you look at the net income, on a quarterly measure, let's say double, okay? I read a lot of posts on Twitter, right? A lot of people think that earnings will continue to double for the next 5 years, 10 years. They build out DCFs, discounted cash flow models, where you have a growth rate of 80% per year for the next 10 years. And I think this is purely delusional at this point. Yes, you can have some optimism for a stock, but to a certain extent. Now, justifying a PE ratio that high because you think the business will grow substantially, that takes a lot of efforts. If it works out for you, congrats, you are a genius. But for most people, I would not recommend this kind of investing. This will be very stressful. And if for some reason the company is not growing 100%, but is only growing 15% per year for some reason, the stock will crash immensely. We know this because it has happened in the past. You see the same phenomenon for other stocks. You have, for example, Upstart that is now plus 30% year to date. If you don't know Upstart, they make the equivalent of credit scores in the US. So AI, cloud, giving score to people to have a loan, like a lending platform with AI. Okay, that's the business model. For example, maybe you are familiar with another company called FICO, Fair Isaac. Let me just explain what the business does so you understand better. Maybe you know Fair Isaac, wonderful company, high margin, almost a monopoly. They give the credit score, the FICO score in the US. In case you want to apply for a loan, you need a score. If you have a good score, they give you a loan in the US. And this is a monopoly. What is the base for this score between 400 and 900 in the US? Well, you need to have paid in a good amount of time your past loans. You need to have a good job, etc. But what if you are somebody? What if you are 21 years old? What if you have never had a loan before? How do you base this score? On which measure? This is where AI comes to the table. You use where the person lives, when the what is the job of this person, and you have the algorithm, an AI algorithm that gives you a score. That's Upstart. You know what they do? That's an alternative to the FICO score. And now the stock is up 30% year to date. They delivered great earnings, and the company jumped 20% in one day. Wonderful, wonderful. Well, if you look at the financials, that is not wonderful. If you look on the quarterly measure, now the company is at break-even. And I see this scenario. I saw the same thing in 2021. And if I click on all, look at the stock chart in 2021. During the pandemic, the stock went up. In 2021, the stock went up to $400. And then the growth in earnings completely collapsed, completely evaporated. Like no growth at all. And it went back to being unprofitable again. It turned sour real fast, and the stock declined substantially from $400 to $20, $30, even lower. But I'm kind with my analysis. If the growth rate stumbles for some reason, if the company becomes in a bad shape again, the stock will collapse completely. And people don't say this. I read a lot on Twitter. I watch a lot of YouTube videos. People don't see this. They just see the 1 year performance and the stock being a triple in 1 year, and they say, yeah, come on, it's the new FICO, it's the new Fair Isaac. So I've been following these two companies for a while now, for a couple of years, maybe 4 or 5 years. So I know the competitive landscape in this industry. Well, I'm not living in the US, but I have learned a lot about this industry. It's very hard to disrupt FICO, Fair Isaac. Their AI lending business model is not that profitable. It's not that efficient. And if you look at the past results of this company, you have a lot of revenue growth that collapsed completely and now is growing again. And for the earnings, not a lot of earnings. You have a lot of costs. You have a lot of investments. And I'm really not sure of Upstart in the future. I wish them the best, but I have a YouTube channel about stock pickers, right? We are not business owners. We are stock pickers. And I don't think Upstart is a good investment for the future in the long term. Now, I can't even put a multiple on the business because the company is not profitable. So now there is an estimate. Wall Street thinks that the business will grow again, and they think the forward PE ratio is 70. What kind of growth rate do you need to justify a PE ratio of 70? That is immense. All the metrics are adjusted. You have a fake number, fake data, you burn cash, and now the company is at break-even. I wish that the company was profitable, heavily profitable. Maybe it will happen in the future. The goal of this video is be careful. Be very careful if you plan to invest in these retail stocks. These are the new meme stocks. These were the meme stocks in 2021, and now I see that more and more you have meme stocks in 2025. Palantir is a good example. Meme stock doesn't mean it's a bad business. It means you have a lot of crowd, retail getting interested in the stock, right? I mean, that's fine. Same thing for Robinhood or maybe Hims and Hers to some extent, but not necessarily. You have a Grab right now. You have a lot of things happening in these businesses, and now it's a good time. Now they see growth again. But the moment growth stops, the stock will collapse, will drop like a rock. Not a lot of people think this way, and this is the way I started this video. These guys that invest in Upstart now are mostly new investors. Sorry, from what I have read, they have not invested in Upstart in 2020, 2021. They didn't experience this this drop in stock price. maybe it will happen. If you look at the other side of the coin, it means that there is more upside for Upstart, and the stock can go from $80 to $200. So maybe the stock is a double, or can completely crash. I don't know. I don't know where the madness of crowd can take us, but what I see is a difficult business model, unproven, struggling, unprofitable. The company has some debt, and they are diluting shareholders every year. Look at these red charts, red bars, dilution of shareholders. They are not making money, so the only way they get cash is through dilution, and they just destroy shareholder value. Look at this. On an annual basis, or even trailing 12 months, they have, wow, that's a lot. They have diluted 8% of the shares. They have added 8% more shares. So you, as a shareholder, you own less of the business. Same thing for 2023. They diluted the shareholders by 6%. They did some buybacks in 2022. In 2021, they diluted by 14%. That's a lot. So be very careful. Another example I have for you is Robinhood. Robinhood is famous. The year-to-date performance is plus 60%. We all know what they do. That's a brokerage app. They had an amazing earnings report with a lot of revenue growth coming from cryptocurrencies. Okay, very well. I mean, that's a good business. That could be the future biggest broker in the coming decade. I have nothing about the business model, nothing about the management. The vision is clear. What I am afraid of is the optimism around this stock. Look at this, look at all performance. A similar scenario happened in 2021. And in 2021, I was there. And that was not a long time ago, that was 4 years ago. And the investor presentations at the time, you can check them, this is online. The investor presentations of Robinhood in 2021 were bullish, optimistic, a lot of growth. That's magnificent. And you know what? It turned south, and it didn't happen like they did. So the stock went from $40 to $10. And now the stock is back to $60. And people are optimistic again. Okay, this is a nice business. The PE ratio is quite high for a brokerage platform. Being a PE ratio of 50, that's quite high. And the business is making money now. Okay, fair enough. They delivered some extraordinary results for their cryptocurrency segment. So congrats to them. But now I see a lot of people on Twitter and YouTube expecting the business to continue to grow at the same rate for the next 5 years of 10 years. And that is where the mistake is. It's not because the company has been profitable for 1 year that you have to forecast the earnings to grow for the next 10 years. You've seen it with Upstart. Things can turn. The growth rate can be up really high, and then you crash like a rock. It's difficult to live in a capitalistic world. You have a lot of competition, and these companies can be great, but they are suffering from competition. So, my point is, Robinhood has been profitable only for 1 year. Look at this, in the green net income. If you look at the net income, it was always negative, and boom, profitable. 1 year of profitability. And everybody's forecasting the growth to continue in the future and to grow 20% per year, 30% per year. So it's the biggest deal ever. It will become the biggest platform ever. Take your time. You are not in a hurry. Don't rush into buying the stock. You are not forced to buy it now. And I'm afraid that these new investors that recently joined the stock market, that are expecting 20% per year for the next 10 years, they will be disappointed. And when the market will crash for some reason, recession, interest rates, anything, conflicts, inflation, anything. If the whole market drops 30% for some reason, these new investors will crash with the market and will cry and will blame the Fed and will blame the US administration. It's not the fault of Jerome Powell. It's not the fault of the current administration in the US. It's just different kind of investing. And there is something about investing. I mean, you have investing and speculation, right? Investing is when you analyze a business, you like the business, you think, oh, I can be an owner of this business, I would like a share of this business. You buy a stock and you wait for a couple of years because you believe in the business, you believe in the thesis. And you have speculation. You do an analysis just because you think the stock will go up. And when the stock is going up and it's a triple, you sell your position and you find another speculative investment. This speculation is much more stressful than the investing part. And if you fall into this trend, if you follow this trend of speculation, going from share 1 to share B, share 2 to share 3, and you will be disappointed. I mean, this is very, very stressful, first. And secondly, maybe you will have mistakes. Strangely enough, for the people that invest in Robinhood, etc., they don't show you the trades that went wrong. For each Robinhood, I suspect you have mistakes, other investment that went sideways, that went bad. But strangely enough, we often talk about the big winners of the market. This is the way the human brain works, right? And now I see a couple of people, a lot of people. Actually, all my Twitter feed is filled with posts about Grab. Grab that is up 3% year to date. And if you look at the performance for year all, it's been bad performance. The stock IPO'd, the company went public in 2021, collapsed from $10 to $2, and now the company is back to $5. Okay, how big can it grow? In case you don't know Grab, that's the equivalent of Uber Eats, mega platform, super app equivalent in Southeast Asia. So it's a WeChat. I mean, it's big. And for a lot of countries over there in Asia, they use Grab as a main app. So I agree, it's a super app. It's quite big. It's quite efficient. It's quite cheap. So I have nothing about the company again. And if you look at the performance, financial performance, the company has always been unprofitable. And seems like the profitability is going to go break even. Look at this net income. Now the company is at break even. And people anticipate that the earnings will be at break even and then grow at 30% per year, 20%, 30% per year. I've seen some analysis, some stupid analysis on Twitter. Be careful, guys. Frankly, be careful. The company, maybe in 2025, the company maybe will be profitable. So 1 year of profitability. And people already expect 20% growth for the next 5 years. I mean, that's hard enough for Google and Amazon and Microsoft. And we know a lot. With all the information we have, it's already hard to have a DCF for big tech companies because of the world that is moving, the capex that is changing, etc., the margins, the competition. And now, for some reason, one small company, never been profitable, people expect a 30% growth for the next 5 years and are dead sure it will happen because it follows other companies. The market cap is $20 billion. I agree that it can be more because that's a big market in Southeast Asia, and this is a super app. This is great. But in terms of investment and profitability, investing in strong brands, strong, efficient business model, I'm not sure at all. The message of this video is be careful, guys. Be careful. I don't think we have a lot of speculators watching this YouTube channel. This is not a YouTube channel for speculators. If you are speculating, please unsubscribe. But this is a channel for stock pickers. The advice here is don't follow this trend because you will have FOMO. In 2023, 2024, now 2025, maybe you have a strong portfolio of great companies, Microsoft or Chipotle or Adobe or Costco, and you grow nicely. Imagine you grow at 15%. And you see young guys my age on Twitter, YouTube, that are making 30% per year, 50% per year, making a lot of money on Grab, Robinhood, Upstart. Maybe you will have FOMO. You will experience FOMO, fear of missing out. this is exactly what happened in 2021. I'm making this video because I think it's exactly the same scenario as in 2021. I was here with my Texas Pacific land. I had Apple at the time. I had Google and Facebook making some money, and you had some guys on YouTube, Twitter making 200% per year. The difficulty here is to do nothing. This is also what Warren Buffett teaches us. Warren Buffett is not being paid for activity. He's being paid for being right in the long term. In the short term, anything can happen. You will have volatility. You will have ups and downs. You will have a market sentiment change. You will have tariffs. You will have China that will come to the equation. Some conflicts. That's pure short term. What I want to do with my portfolio is to only focus in the long term on what matters. Earnings per share, margins, free cash flow per share. This is what matters. And for these companies, we are not following the same pattern at all. So this video is for people that are maybe suffering from FOMO. You have some pockets in the market that are crazily hyped, crazily optimistic behavior in these pockets. Be really careful. Be really careful because things can turn really fast. We've seen this with Upstart. And I will finish this video with that. Now the retail crowd is making a lot of money. Congrats to you guys. I'm not criticizing their style of making money. Just this is a different game, so we have to be careful. Retail investors are getting really confident that they can make 30% per year in the stock market. And I've seen more and more posts that are quite dangerous on Twitter. More and more posts of people criticizing big funds. Where should it be Citadel or Fundsmith with Terry Smith or Chris Broomstram, and they say, oh, these guys have big funds, you manage hundreds of millions of dollars and you still underperform for the past 2 years. What a loser. Come on. People on the retail crowd look at the past 2 years of performance and they think they know more than big hedge funds. For example, I'm taking the example of Terry Smith. He has been investing for decades and has had a better performance than most investors. Or even I've seen the same thing for Chuck Acre. Maybe you have seen this post on Twitter too. Chuck Acre, that is investing in boring businesses, that is underperforming. A lot of retail investors have a lot of confidence in the market. This is what I try to say. I don't like this trend at all. I don't like how confident the retail investor is. I don't like how cocky the retail investor is. And I will be very careful for 2025. You know what? If the market drops for some reason in 2025 and the market is down 20%, I wouldn't be surprised. And I wouldn't be surprised to see a lot of posts of people crying on Jerome Powell or Trump or whatever because they lost money on speculative bets. Be cautious. You are my subscribers. You know that we invest for the long term. Focus on the businesses. Buy good stuff at a cheap price. Don't look at stock prices too often. You buy well and you sleep. You just monitor from a distance. But the more you look at the stock market, the more FOMO you will feel. So the more mistakes you may do. This is a mistake to shift investment strategy. I have learned this the hard way. Just focus on one strategy. You stick to it. But this change in confidence from retail investor, that's strange. Also, I'm receiving more and more comments focusing on Grab or can you check out this and this. And some people still continue to pitch me ideas in the comment section below, but sometimes I receive stock pitches, stock ideas, micro caps, unprofitable, with a lot of SBC, no revenue growth, but the stock is up. So I should analyze it. My response to you is I will not analyze companies that don't grow, that are unprofitable, that have a lot of cash, and that have no efficiency at all and that dilute shareholders. This is not my style. Why should I analyze it? I will only invest the best companies that I think have potential in the future. So in the future, please don't don't ask me to analyze a bad company that is unprofitable. Just pitch me the best ideas you have and we'll analyze it together. I will only make videos on companies I think have a good potential. So shoot your shot. That's it. That's it for this video. I don't know how long this video is, but yeah, be careful, guys. And I'm sure of what I will do. I will not touch these meme stocks. I will not touch these speculative assets. Maybe my neighbor will be much richer than me and will grow much faster. I'm fine. You know what? Even if I make 15% this year or 10%, I'm fine. I will not take risks for my investors. I have 500 people that copy my portfolio on eToro. I don't want to take additional risks for them. So I'm fine for that. And I believe strongly in my companies. I think we can grow 20% safely. I mean, because the earnings per share will grow 20%. Maybe not this year, but over the long term, I'm quite confident with the portfolio I have. So pay attention to the valuation also. That's the last advice for this video. Valuation will be very important. We know what interest rates are expected to go down in 2025. But maybe if inflation picks up, interest rates may go up. And if interest rates are going up in 2025, the cost of debt will be higher. And who will suffer? Which stock will suffer? The speculative stocks. The speculative companies filled with debt and that need debt to grow. They will completely collapse. I mean, we've seen this. I'll show you examples. You have plenty of other meme stocks that completely collapsed in 2022 like this. History is a good indicator of the future. Strangely enough, it rhymes. So be careful of valuation. Invest in great businesses. I hope this video was a great reminder to be cautious in this market that is on the PE ratio based on the pure metric. This market is expensive, not crazy expensive, but rather expensive. So we have to be careful. We have to pay attention because things will turn eventually. We will have a market correction of 20% eventually. Nobody knows when, but I don't know. I don't even think about it. It will come. Maybe in 2025, maybe 2026, 2027. It will come eventually. So be prepared and be careful with the portfolio management. If you like this content, I have an investing coaching program. In this program, you will learn a complete investing process. You will learn how to find good stock ideas, how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio. Additionally, you will have access to my personalized guidance for long-term results. We will do weekly calls where we analyze stocks together, and you will have access to my private number available 24/7 for full support. If you are blocked, if you have any questions, I'm here to help. Click the first link in the description to get more information. You will get a video that explains how everything works completely for free. No need to sign up, no need for your email address. Just click the first link in the description and I'll see you on the other side.